I was sitting in an economics lecture at MIT 3 years ago when a student asked the professor a question that seemed perfectly reasonable. If we abandoned the gold standard in 1971 and modern currencies are based on trust in governments rather than precious metals, why do central banks still hold 35,000 tons of gold worth over $2 trillion instead of selling it and using the money for education or infrastructure? The professor paused for a long moment, then said something I'll never forget. Because at 3 a.m., during a financial crisis when markets are collapsing and currencies are failing and trust is evaporating, gold is the only asset on a central bank's balance sheet that every other central bank in the world will accept without question, at full value, instantly. That's worth more than any interest payment or investment return could ever be. That answer sent me on a 3-year investigation into why gold, which most people think of as an ancient relic, still plays a critical role in modern economies that would struggle to function during crisis periods without it. Let me start with the data that reveals just how central gold remains to global finance despite 53 years since the end of the gold standard. According to the World Gold Council, central banks globally hold approximately 35,400 tons of gold as official reserves. At current prices, around $2,000 per ounce, that represents roughly $2.3 trillion in value, sitting in vaults from New York to Frankfurt to Beijing. The United States holds 8,133 tons, the largest national reserves. Germany holds 3,355 tons. The International Monetary Fund holds 2,814 tons. Italy, France, Russia, China, Switzerland, Japan, India all hold massive gold reserves that have been accumulated over decades and are maintained at enormous cost rather than liquidated for cash that could earn returns. This isn't irrational behavior by the world's most sophisticated financial institutions. This is revealing behavior that tells you something fundamental about gold's continuing role. I created a graph showing central bank gold holdings as a percentage of total reserves over the last 50 years. And the pattern is fascinating because it reveals how gold's role has evolved rather than disappeared. In 1971, when Nixon ended dollar convertibility to gold, central banks held approximately 72% of reserves in gold. By 1980, that had fallen to 47% as countries diversified into currencies and bonds. By 1990, 31%. By 2000, just 18% as the technology boom and dollar dominance made gold seem obsolete. But then something changed. After the 2008 financial crisis, the percentage started climbing again. Today, gold represents approximately 15% of global central bank reserves, and that percentage is rising for the first time in 30 years. Countries aren't abandoning gold in the modern economy. They're quietly reaffirming its importance after learning hard lessons about what happens when trust in other reserve assets evaporates. I needed to understand the specific functions gold serves in modern economies that other assets cannot replicate. So I interviewed Dr. Robert Kaplan, who worked at the Federal Reserve Bank of Dallas for 11 years, and now teaches monetary economics at Yale. His explanation was methodical and eye-opening. Gold serves 3 critical functions in modern central banking that justify its continued role, he told me during our video call. First, it's the ultimate liquidity asset during crisis. When markets freeze and normal lending channels stop functioning, central banks can swap gold for currency or use gold as collateral for emergency loans from other central banks. The Bank for International Settlements in Switzerland facilitates gold-backed lending between central banks precisely because gold is universally acceptable collateral when nothing else is trusted. Second, gold is portfolio insurance against catastrophic currency failure. If the dollar or euro or yen faced a severe crisis, destroying value, central banks holding gold would maintain purchasing power to continue functioning. And third, gold signals credibility. A central bank with substantial gold reserves is signaling to markets and other nations that it has the resources to defend its currency and honor obligations, even in extreme circumstances. The role of gold during the 2008 financial crisis provides a perfect case study of why modern economies still need it. I researched central bank emergency lending operations during the crisis and discovered something most people don't know. Gold-backed credit lines between central banks were crucial to preventing complete financial collapse. When Lehman Brothers failed in September 2008, and interbank lending froze because banks didn't trust each other's solvency, several European central banks that needed dollar liquidity but couldn't access normal funding channels used their gold reserves as collateral for emergency dollar swaps with the Federal Reserve. The Fed didn't need to verify the European banks' balance sheets or assess their credit risk because gold collateral eliminated that risk. They could lend dollars against gold immediately, keeping liquidity flowing at the moment when traditional credit assessment would have taken too long. That's a function gold serves that no other asset can replicate because no other asset is universally trusted at full value during crisis. I spoke with Jennifer, who manages a sovereign wealth fund and deals with central banks regularly in her role coordinating reserve investments. Her perspective on gold's continuing importance came from practical experience rather than academic theory. When our fund needs to conduct a major transaction with a central bank, especially in emerging markets or during periods of market stress, we often use gold as the settlement asset, she explained. Why? Because gold eliminates currency risk, eliminates concerns about payment system failures or sanctions, and provides immediate finality. If we're transferring $2 billion in value to a central bank in Africa or Asia, settling in gold means both parties know the transaction is complete and irreversible the moment the gold moves. Settling in dollars or euros means trusting payment systems, correspondent banks, and political relationships that could change. Gold is the simplest, cleanest settlement asset for large transactions between sovereigns. That's not a relic of history. That's modern finance functioning at the highest level. The graph I created, showing the correlation between financial system stress and gold's importance, is remarkably clear. I plotted a financial stress index measuring market volatility, credit spreads, and banking sector health against gold as percentage share of central bank reserve additions over the last 25 years. During calm periods, like 1995 to 2000 and 2003 to 2007, central banks added minimal gold to reserves, focusing on currencies and bonds. But during stress periods, the relationship inverts dramatically. During the 1997 Asian financial crisis, gold additions spiked. During 2001-2002 dot-com crash and recession, moderate increase. During 2008-2009 financial crisis, massive increase. During 2020 pandemic, record increase. The pattern is undeniable. When the modern financial system is under stress, central banks return to gold because it's the only reserve asset whose value does not depend on another institution's promises or another country's stability. What makes gold uniquely valuable in modern economies is understanding what economists call no counterparty risk. I interviewed Professor Sarah Martinez at the London School of Economics, who studies this concept, and her explanation clarified why gold remains irreplaceable. Every other reserve asset a central bank holds involves counterparty risk, she explained. When you hold U.S. Treasury bonds, you're exposed to the risk that the U.S. government might default or inflate away the debt's value. When you hold euros, you're exposed to European central bank policy and Eurozone political stability. When you hold deposits at a foreign bank, you're exposed to that bank's solvency and the host country's regulatory decisions. But physical gold sitting in your vault has zero counterparty risk. It can't default. It can't be inflated by another country's central bank. It can't be frozen by sanctions or political decisions. In a world where geopolitical tensions are rising and financial weaponization is increasingly common, that zero counterparty risk property is extraordinarily valuable. It's why even the most technologically advanced economies with sophisticated financial systems still hold hundreds of billions in gold. The role gold plays in international trade settlement, though less visible than central bank reserves, reveals another dimension of its continuing importance. I obtained data from the Bank for International Settlements, showing that gold is still used to settle certain categories of international transactions, particularly between central banks and in trade relationships where currency or political tensions exist. When countries do not trust each other's currencies or want to avoid using the dollar for political reasons, gold provides a neutral settlement option that both parties will accept. Annual gold settled trade isn't enormous in absolute terms, perhaps $80 to $100 billion, but it's concentrated in situations where no other settlement method works, making it critical for maintaining trade relationships that might otherwise collapse. I spoke with Michael, who spent 23 years trading currencies for major banks and now runs a consulting firm advising central banks on reserve management. His perspective on why gold persists in modern economies was pragmatic and compelling. Modern economies run on trust and confidence, he told me. Central banks hold gold because it's the tangible proof that they have real assets backing their currency and can meet obligations, even if trust breaks down. Think about what gives the dollar or euro value. It's trust that the Federal Reserve or ECB will maintain purchasing power and honor obligations. That trust is based partly on the central bank's balance sheet strength. Gold on that balance sheet is the most credible form of strength because it's not someone else's liability. It's just intrinsic value that's been recognized for thousands of years. The psychology of that matters enormously. When markets panic and investors question whether central banks can maintain currency value, the gold reserves are what reassures them that even in worst-case scenarios, the central bank has real assets. That's worth maintaining even though gold pays no interest and costs money to store and secure. The technological modernization of gold's role in economies is something most people miss entirely. I researched how central banks actually manage and move gold in the modern era, and it's far more sophisticated than most people imagine. The London Bullion Market Association oversees a digital gold allocation system where central banks can transfer gold ownership electronically without physically moving it. Gold, sitting in Bank of England vaults, can change ownership from the Federal Reserve to the Bundesbank to the people, as Bank of China, through encrypted digital messages, providing instant settlement of large transactions without the cost and security risk of physical transport. This modernization means gold functions in the digital age as efficiently as any electronic currency, eliminating one of the main objections people have to gold's continued relevance. What emerged from my research is that gold's role in modern economies has evolved rather than disappeared. It's no longer the foundation of the monetary system determining exchange rates and money supply, as it was under the gold standard. Instead, it's become the insurance policy and emergency asset that makes modern fiat currency systems more resilient and trustworthy. The fact that central banks hold $2.3 trillion in gold they could otherwise invest in interest-bearing assets tells you how valuable that insurance is. They're willing to forego potentially $30 to $50 billion annually in investment returns by holding gold instead of bonds, because the optionality gold provides during crisis, the liquidity it offers when all else fails, and the credibility it signals to markets is worth far more than any interest payment. The conclusion I've reached after 3 years investigating this question is that gold plays a continuing role in modern economies precisely because modern economies, for all their technological advancement and financial sophistication, still run on trust, and trust is fragile. Gold serves as the backstop that maintains confidence when that trust is tested. It's the asset central banks hold so that when every other asset on their balance sheet is questionable, when currencies are fluctuating wildly, when credit markets are frozen, when geopolitical tensions threaten normal financial relationships, they still have something of unquestionable value that every other participant in the global economy will accept. That's not nostalgia for the gold standard or ignorance about modern finance. That's sophisticated understanding that the more complex and interconnected the financial system becomes, the more important it is to have a simple, universally accepted asset that doesn't depend on anyone else's promises. The ending I want you to understand is that gold's continuing role in modern economies is not about reverting to old systems. It's about maintaining stability in new systems that are ultimately based on confidence. As long as currencies are backed by trust rather than tangible assets, as long as financial systems can freeze during crisis, as long as geopolitical tensions can disrupt normal economic relationships. Gold will remain relevant because it's the one asset that transcends all those vulnerabilities. The 35,000 tons sitting in central bank vaults aren't there by accident or tradition. They're there because the smartest financial minds in the world have calculated that the insurance value, the crisis liquidity, the universal acceptance, and the credibility that gold provides is worth maintaining at enormous cost because the alternative, facing the next major crisis without that backstop, is simply too risky for modern economies to contemplate. Gold's role has changed, but it hasn't ended. And as long as human trust remains imperfect and crises remain inevitable, gold will continue playing a critical role in economies that most people think have moved beyond it.